Get ready for the biggest market movers. We start today with the incredible performance of Amazon. The company's chip business, combining graviton, tranium, and nitrosilicon, has exited the first quarter of 2026 with an annual revenue run rate above $20 billion. CEO Andy Jassy revealed that if that chip business operated alone, its revenue run rate would hit $50 billion, cementing Amazon's position as one of the top 3 data center chip businesses globally. This is a massive story about how Amazon is evolving from a customer to a peer in the hardware world.
Here's a simple way to protect your phone without stress. This AMZN 3-pack comes with tempered glass screen protectors, camera lens protectors, and an installation frame for an easier, cleaner fit. It's clear, case-friendly, and built to help guard against scratches and everyday bumps. Check the link in the comments to get it on Amazon.
Next up, we dive into the massive demand fueling Amazon's silicon success. We look at the staggering commitments Amazon holds, including over $225 billion in revenue commitments for Tranium alone. Furthermore, anchor customers like Anthropic and OpenAI have signed on for colossal amounts of Tranium capacity, signaling that the future demand for this technology is absolutely unstoppable. We'll explore how Tranium 3 is already shipping, and how this technology is saving Amazon billions in capital expenditures. Now we pivot to the global markets with some steady income plays. We're looking at the ASX 50 dividend picks, focusing on blue-chip stocks offering steady income in this volatile environment. We will be examining how OCBC is emerging as one of the strongest income engines in the market, reporting record total income despite a declining interest rate environment, and how their diversification story is driving significant non-interest income growth. Finally, we look at the Singapore market with 3 blue-chip stocks rewarding investors this week. We're breaking down the earnings prints for OCBC and UOB to see if their foundations are still intact amidst margin headwinds, and we'll check Keppel Limited to see if their dividend sustainability is truly secure. Don't miss out on this deep dive into income stability and how to navigate uncertainty. Subscribe now for more essential market insights. Investors are traditionally drawn to semiconductor giants like NVIDIA, Intel, and Broadcom when considering the artificial intelligence hardware buildout. However, a recent analysis suggests a compelling alternative: Amazon, a massive e-commerce and cloud computing giant whose internal chip business may be a more significant player than previously acknowledged. Amazon's chip division, encompassing graviton CPUs, Tranium AI accelerators, and Nitro virtualization silicon, reported a first-quarter annual revenue run rate exceeding $20 billion, marking nearly 40% sequential growth and triple-digit year-over-year expansion. Despite these figures, Amazon CEO Andy Jassy indicated that the true scale is understated, estimating that if the chip business operated independently, its annual revenue run rate would reach $50 billion, positioning it among the top 3 data center chip businesses globally. The forward demand outlook for Amazon's custom silicon is exceptionally strong. The company holds over $225 billion in revenue commitments for Tranium alone, with major customers like Anthropic and OpenAI securing significant capacity allocations. Management highlighted that newer generations of chips, Tranium 3 and Tranium 4, offer substantial price-performance improvements over previous models, which translates directly into cost savings for Amazon Web Services, AWS, and an operating margin advantage for Amazon. While the ramp-up in capital spending has compressed Amazon's trailing 12-month free cash flow, the multi-year nature of customer commitments and a substantial Oz backlog of $364 billion suggests sustained demand. Analysts suggest that while share valuations are no longer cheap, a forward price-to-earnings ratio of around 32 may be justifiable given the simultaneous acceleration in both Amazon's cloud and silicon segments. Ultimately, the report posits that for investors seeking exposure to the AI hardware wave, without relying solely on pure-play chip valuations, Amazon presents a uniquely compelling investment case, supported by its dual-engine momentum in cloud computing and custom silicon. Amazon is emerging as a critical player in the artificial intelligence hardware landscape, challenging the traditional focus on pure-play semiconductor giants like NVIDIA, Intel, and Broadcom. Amazon's integrated chip business, encompassing Graviton CPUs, Trainium AI accelerators, and Nitro virtualization silicon, demonstrated significant momentum in its first quarter results, with an annual revenue run rate exceeding $20 billion. CEO Andy Jassy highlighted the potential scale of this division, stating that if treated as a standalone entity selling chips to Oz and third parties, the business's annual revenue run rate could reach $50 billion. Jassy emphasized that Amazon's custom silicon business is now ranked among the top 3 data center chip businesses globally, signaling a shift from being a customer to a peer of industry leaders. The growth trajectory is steep, with the chip business expanding nearly 40% sequentially and experiencing triple-digit year-over-year growth. This momentum is directly fueling Amazon's fastest cloud computing growth rate in 15 quarters. Forward demand for Amazon's AI chips appears staggering. The company holds over $225 billion in revenue commitments for Trainium alone, with anchor customers such as Anthropic and OpenAI securing massive capacity allocations for Trainium and the forthcoming Trainium 3 generation. Management projects that Trainium 3 will offer 30% to 40% better price performance than its predecessor, and leveraging Trainium instead of third-party GPUs is projected to save Amazon tens of billions of dollars in capital expenditures annually, while providing significant operating margin advantages. Despite the massive growth projections, investors must note risks, primarily the collapse in trailing 12-month free cash flow, which dropped to $1.2 billion from nearly $26 billion the previous year due to extraordinary capital spending. However, substantial, multi-year customer commitments, including an Oz backlog of $364 billion, suggest this capital expenditure cycle is robust. While NVIDIA, Intel, and Broadcom remain dominant names, Amazon's integrated approach offers a compelling alternative for investors seeking exposure to the AI hardware wave without the premium valuation multiples associated with pure-play chip stocks. Analysts suggest that Amazon's dual strength in Oz and custom silicon positions it as a particularly compelling investment right now. The Australian Securities Exchange is currently experiencing a multifaceted market dynamic, with recent news highlighting shifts across various segments of the market. Analysis from Calcane Media points to several key areas of investor interest. A notable concern has been the sudden loss of momentum in an Allure DS gold stock, prompting scrutiny of its recent performance. Concurrently, the broader ASX 200 market is showing mixed signals, characterized by rising highs juxtaposed with persistent lows. Furthermore, attention is increasingly turning towards the small-cap sector, with analysts investigating the driving factors behind the growing buzz surrounding these stocks. In contrast to the broader market movements, specific focus is being placed on the ASX 50, where blue-chip stocks are being highlighted as reliable sources of steady income, offering investors a pathway to consistent returns. These developments underscore a period of divergence and strategic focus within the Australian market landscape. 3 Singapore blue-chip stocks are set to reward investors with dividends this Thursday, May 8, 2026, offering a snapshot of differing financial health and dividend sustainability. OCBC, UOB, and Keppel Limited are the key players, each presenting a distinct investment narrative. OCBC demonstrated robust performance, reporting record total income of $14.6 billion for FY 2025, driven by a significant 16% surge in non-interest income to $5.5 billion, largely from wealth management fees and insurance income. Despite a 2% slip in net profit to $7.4 billion due to higher taxes, the bank maintained a comfortable 60% ordinary payout ratio, distributing $0.99 per share. Management guidance for 2026 signals stable income, with a 50% ordinary payout ratio, providing a strong foundation for investors. UOB presented a more challenging picture. While the headline suggested a dividend cut, stripping out a special dividend from the prior year, ordinary distributions actually grew from $1.30 to $1.56 per share for FY 2025. However, underlying earnings faced pressure, with total income down 3% year-on-year and a net profit decline of 23%, partly due to provisions for macroeconomic uncertainty. UOB's outlook points to continued margin headwinds, although record fee and commission income of $2.6 billion, bolstered by wealth management fees, offers a potential buffer. Capel Limited offered the most nuanced view. The group proposed a total FY 2025 dividend of approximately $0.47 per share, a 38% increase from the previous year. However, the ordinary cash dividend remained flat, with the increase attributed mainly to a special dividend paid largely in specie. The operational side remains positive, with the new Capel segment showing a 39% profit climb year-on-year and improved net gearing. The durability of future ordinary payouts hinges on the fee income engine, with funds under management targeted at $100 billion by the end of 2026. Shareholders for OCBC and UOB will receive their payments on May 8, with the upcoming earnings releases providing critical data on the stability of their respective financial foundations. The market remains volatile amid rising oil prices and fluctuating tech stocks, underscoring the importance of analyzing underlying income streams rather than short-term predictions.